Before we get into today's video, some regulatory compliance. My name is Andrew Alexander. I am Head of Investments for Three Counties, an independent financial advisor based in County Durham, England. This video is for anyone who has an interest in investing and investment markets, both retail clients with no experience of investing through to industry professionals who invest for themselves and their clients. As independent financial advisors and wealth managers, there is no commercial relationship between ourselves and today's guest. The purpose of this video is educational, and in no way should any of the content be construed as advice, nor is it an enticement to invest. Past performance is not a guide to future performance, nor a reliable indicator of future results or performance. The value of investments may go down as well as up and is not guaranteed. Therefore, investors may not get back the amount originally invested. And now, onto the video. Welcome everyone to another of our weekly investment manager videos, and many thanks once again for tuning in. It's Christmas week, hence the get up, and the final video in our series of end of year market roundups and outlooks into 2022. And so far, it's all been about equities, so it's time to change that and cover off the area that pretty much everyone has exposure to, but possibly the area that everyone overlooks: UK investment grade credit. And who better to talk to about this hugely important aspect of investment portfolios than the guy that, in my eyes, and it is just my opinion and what do I know, is not only the best UK corporate bond manager in the country, but perhaps the best fund manager in the country. That's what you call an intro for Christmas. Jonathan Golan, manager of the GLG Sterling Corporate Bond Fund. But first, before we get into the content, and it is Christmas, it would be wonderful if you could subscribe if you haven't done so already. It does help us in delivering this content to everyone, be it investment management or financial planning. So, on to the content. Jonathan, many thanks for joining me today. It's an absolute pleasure to speak to you again. Kicking things off, 2021 has been an interesting year for so many markets. How's the last 12 months been for UK corporate bonds?
First of all, thank you for the lovely introduction. And clearly, you've saved the best for last. So I'll try to
Absolutely. Absolutely.
I'll try to live up to the introduction. So I think 2021 was very interesting year in the bond market, because I guess the bond market grappled with this sort of tug of war between the positive economic momentum that is typically reflected by corporate bonds doing better than government bonds, but also with that fear of inflation that we've seen has really skyrocketed across the globe, and particularly in the UK as well. So I think that was on the balance the entire year, and actually, unlike equities, corporate bonds actually had a pretty mediocre year overall. So when I look at the Sterling Investment Grade Index, for example, year to date, it has delivered negative total returns, which has really only happened in 2 out of the last 23 years or so. So 2008 being one of them, and then 2018, which was the previous rate hiking cycle. And in a way, I guess, makes bonds an alternative again, or an important part of a portfolio, because we have some rate hikes priced in, and therefore, if there is a disappointment for some reason, then bonds could provide protection with these sort of rate hikes being priced out.
Yeah, and I think that's something that a lot of people miss. It's the position within the portfolio, the very valuable position. You can't just go one way or the other. You need to have that, real focus upon diversification. You've already touched upon inflation and, looking at the macro picture, rising COVID variant cases, or the lockdowns that we're seeing across Europe. How is your outlook for 2022 forming at this point in time?
So I think just going a step backwards, and I think you really brought an interesting point, because sometimes it's not what is the expected return, but also what is the expected return under different scenarios. So you don't buy fire insurance because you think your house is going to get burned down, but because you want to be compensated in that eventuality. And I think this sort of portfolio construction angle is what some investors are missing. And I think it's particularly important if you're later on in your life and you're already thinking about retirement, and in a few years, if there is this drawdown, you need a part of your portfolio, probably a considerable part of your portfolio, that can actually hold its value under those circumstances. I think going into 2022, in a way, we always run the funds in a similar fashion. So we don't really try to capture necessarily where the cycle is going or be very directional, but we try to think about bonds from a mid-cycle perspective and ensuring that every single bond that we buy has a yield that is attractive in the absolute sense and has a margin of safety relative to the credit risk. And I think it's a good way in general for people when they think about their portfolio, always making sure that you're running a balanced portfolio, because what is going to happen with COVID or inflation? The reality is, I do not know. I think about it a lot. I read about it a lot, but I want to be positioned for every eventuality that may transpire. And I want to make sure, like Warren Buffett says, that if the market is closed for the next 10 years, that I'm comfortable that our bonds, the companies, will be able to pay the interest and repay the principal. And I'm not concerned about sort of short-term gyrations. And I really think in this day and age where you have Reddit and really increased level of trading, it's like sometimes it's just actually important to take a step back and make sure that your portfolio is balanced and diversified, because you're not going to be able to time the market perfectly. No one can. And there's just things that are beyond our control. We don't know how the coronavirus situation is going to develop. No one knows. And therefore, it's important to be positioned not only for a bull side scenario, but also for a bear side scenario. So if there's one takeaway I can leave our listeners with, is making sure that your portfolio is balanced for every eventuality and not just one eventuality.
Again, I think it's the hallmarks of, in my view, the hallmarks of quality funds, consistently well-performing funds, is that all-weather approach to remove yourself from ultimately emotion and just look at the fundamentals of the assets that you're holding. So I completely agree with that approach. As I mentioned at the beginning of the video, most UK investors have a corporate bond allocation, yet will focus the vast majority of their thoughts and their investment decisions on the equity portion. What one thing would you suggest that they consider in their corporate bond allocation as the global economy starts to emerge post-pandemic?
It's really, you raise a really interesting point that investors allocate a lot of capital to corporate bonds, and they do it as sort of an afterthought.
Yeah, absolutely.
And then sort of in equities, they spend all this time. Whereas actually, if you look at the academic literature, active bond funds actually tend to outperform their passive benchmark more than equity funds. So in a way, you should spend more time on your active selection in bond world rather than in the equity world, where it's much more difficult to find fund managers that can actually do that. Well, in terms of what we're doing in 2022, overall, we think market valuations are not particularly attractive. So if you look at the broad market, so corporate bonds, corporate bond yields relative to government bond yields, the spread that you're getting there is not attractive in sort of a 10, 20-year basis. So we wrote an interesting piece, and I guess the listeners can sort of go and sort of have a look if they've got time. We call it How to Navigate the Lowest Yielding Bond Market in History. And one of the points I touched there is that instead of adding risk at this point in the cycle, what we actually recommend is using flexibility. So going to niches in the market where there are pockets of value and capturing that in an opportunistic approach, rather than just buying a passive product, because we think the passive product is unlikely to deliver attractive returns given where yields are. And to just give a flavor of where we think there may be opportunities. So one sector that's been very interesting for us is the real estate sector. You've seen a lot of volatility in China, in the property sector there. Now, we're not investing in Chinese property because we don't speak the local language and we don't have the expertise. But what we found was that volatility has crept through to the UK and to Europe. And we know a lot about European property companies. And that's sort of an area that we found interesting. And again, that's something we always do. And there's volatility in the market. We try to find the sort of collateral damage where we feel like we can get attractive yield without taking extra risk. That's one area that we're finding interesting opportunities. We also like the alternative financial space. So these are companies that are either use their own balance sheet to lend money to corporates or individuals, or they invest other parties' money. So an asset manager.
Yeah.
And what we find is that these companies have a lower leverage than the high street banks, but much better profitability, and we get a higher yield. So it's a sort of a situation of having your cake and eating it too. So this is really what we're trying to do. We're not trying to just get a higher yield, but also better fundamentals.
Yeah.
And this just gives you a flavor of niches in the market where we're finding interesting opportunities.
And what I'll do, I'll put a link. You'll be able to find a link to that article in the video description above. So click on that. My takeaway is exactly what you've outlined there. It pays to be active within corporate bond sector. It really does give additional value for the additional costs that you need to pay to be selective and have that real interrogative look through the companies and really understand what you're exposing yourself to and the potential upside as well, which obviously we're investing. This is what we're all here to do. Jonathan, as ever, it's absolutely great to talk to you, especially on the lead up to Christmas as well. Ho ho ho. Let's hope that we've all been good boys this year and we won't find coal in our stocking, but if we do, never mind, there's always next year. Anyway, Magic, thanks very much for spending your time. You be safe, and we'll catch up soon.